All right, we're starting to get some people file in. Hello, everybody. We're going to give you guys a couple of minutes to get comfortable, get some water if needed, and then we'll get started. Couple minutes and we will get started for those of you that are just now logging in. It looks like we've got some familiar names. Hello, if you have joined us before in previous webcasts. I'm going to go ahead and get started now. So hello, everybody, and welcome to ERPfixers Ask a Fixer webcast. Today we have Kent Bettisworth with us. Before I get into the details and we get started on the presentation, we will have a live Q&A at the end of this session. If you guys have any questions throughout the session that you would like Kent to answer, please put it in the chat box. You can find the chat box below or in the Q&A box, which is also going to be at the bottom of your screen. And I'll be collecting those throughout the presentation. We also will be posting the full recording of this webcast, as well as the answers to your questions, at least the questions that we don't get to by the end of the session, on our website. So let's get to it. What is ERPfixers? We connect you with SAP experts to obtain quality immediate solutions for your SAP system. We consist of thousands of SAP freelancers globally in all SAP modules who are ready to help and assist with their knowledge in SAP. We offer an online platform, SAP Optimization Assessment, Material Ledger, S/4HANA Transitional Roadmap, and Cost Transparency Reports. For more information, please visit our website at ERPfixers.com. So presenting with us today is Kent Bettisworth. He is the CEO and executive consultant of Bettisworth and Associates. After 14 years with ExxonMobil Controllers, he was managing fixed asset and project processes. He founded Bettisworth and Associate in 1995 to deliver business solutions, making SAP information technology work for you. He is an expert in SAP, focuses on assessment and implementation of lease accounting and revenue recognition standards and solutions, and project accounting, fixed asset, and federal tax solutions. He's a Fortune 1000 and private corporation have utilized his and his team's services and advice during the past 2 decades. He's a frequent speaker at SAP conferences and ASEG.
Thank you.
Yep.
Thank you, Jessica. As usual, a great job. Okay, welcome everyone to a exciting topic that I know is on the forefront of everybody's mind, particularly if you're a tax person. So let's talk about what the concept is, and then let's get into the details. So first, we know we have in any country tax depreciation and finance depreciation. And if you have an ERP system, you may or may not have the tax depreciation included in that. Over the last, yes, it's been about 30 years, time flies when you're having fun. I've encountered a lot of situations where the tax managers in particular, and sometimes finance managers, really have a risk aversion or reluctance to put tax depreciation in the same system with the finance assets. And there are a number of reasons for that. We're going to go through some of those and sort them out. Now, what's the big deal about depreciation? Now, there's a famous quote from an unnamed SAP consultant who is fond of saying it's just a math problem. Well, what we know is it's really more than just a math problem. We'll talk a little bit about that. So what I want to do is address the concerns and the obstacles to why folks are reluctant to include tax depreciation with the finance. And I want to talk about several designs that could address those concerns and work for both finance and tax departments in reporting your depreciation. Specifically, we'll get into the challenges and some mitigation steps that you want to take to address those specific challenges. And that's really system agnostic, not necessarily unique to SAP. But then I want to talk about two specific SAP designs, which may work for other ERP systems, but specifically for fixed assets, that gives you some choices to make, particularly on the tax side in terms of how you implement your tax depreciation. And I'll follow that up with a discussion around what I refer to as the relaxed 4-step tax only asset process, and I'll elaborate on that in a minute. Okay, without further ado, left-hand side, we have the classic integrated ERP system. Right-hand side, we have where tax depreciation is managed in a separate system and then simply handed off either through a systematic interface or a upload, or just not uploaded at all to the ERP system. It's just reported separately. Obviously, with depreciation for both finance and tax, you want to have the same starting basis. So getting the acquisition data into both systems reliably, accurately, and at the same base is important. That's usually where some of these challenges start. Let's go into that. I got two slides here that talk about the different challenges. Left-hand side are the challenges or the obstacles or the areas that you want to address to make sure you get accurate finance and tax depreciation. Then some mitigation steps you can take. And then I've added on the right-hand side, what is the risk for those mitigation items if you're in a fully integrated system, meaning you've got tax included with your ERP, versus if tax is completely separate. So let's start with this. So master data quality, this is where it all starts. That's why it's more than just a math problem. You have to have the right asset records, got to have the right asset categories so it gets the correct useful life, gets the correct depreciation key. So one of the ways you tackle that is you make sure that you know what, from a tax perspective, you know what the tax relevant or tax trigger fields are to get those correct asset classes and depreciation keys. Now, that in an integrated system could represent a high obstacle or a high risk of getting that tax relevant field identified and even added into the system. So if you're familiar with SAP, for example, tax might like to have the evaluation group on an asset master record with some specific tax relevant information. Sometimes if tax isn't involved in the initial implementation and they come around later, it's hard to get anybody's attention to actually get you to add that. If you have your own tax system, you're kind of a master of your own destiny. So the risk of addressing that challenge is low because you're in charge. So you're going to put in your tax relevant fields. If you follow that logic all the way through these challenges and the mitigation steps, you'll see that essentially the integrated scenario represents a high to medium risk, meaning it presents some obstacles that are difficult to overcome. You have to go to extra efforts because as a tax manager, if you don't have your own system, you're not the master of your own destiny, so to speak. You have to work with other groups and make an argument for why this needs to be included. It should be an easy argument, but I often find that it's not. So, for example, other things around this master data quality is who owns the data, which part of the data do they own? What about ongoing maintenance? For example, tax laws change, so you need to keep depreciation keys. So who does that? Can tax still do that, or do you have to have an IT person? And that's one more piece of work that they have to account for. Again, another obstacle in fully utilizing the system that you have in this fully integrated scenario. So process controls, clearly you have to have responsibility for the different data elements that are calculating finance and tax. So how do you split that responsibility in a integrated scenario? Separate system, not a problem. Who authorizes access to the SAP system, and specifically who authorizes access to a fixed asset record? Not to mention access to post transactions, as well as running reports. So as we go down this list on the left-hand side, insufficient tax codes and labels. If you don't have these pieces of information available in your system, then you don't have a chance to automate some of that asset creation automatically. And if the tax logic that you need is distributed across your organization, particularly if you have a global ERP system, it's difficult to manage that centrally often. So again, another high obstacle, high risk scenario in an integrated system. Report compliance. Does the tax manager have priority to get the reports he needs? Does SAP even deliver the standard reports that they need? So for example, in the US, there's a 4562 tax depreciation, 4797. We know that there's not a standard US report provided by SAP. So you're on your own. Then we get to the training. So who, are the tax guys simply provided training that looks more like finance training, or is it tailored specifically to what they need? Where you have two separate systems, again, the tax department is more in control of its own destiny, which is part of why you find a reluctance to be part of this bigger integrated system. And it makes sense that if you give up some control, that your payback should be high, and that's not often the case. Just another list of more things. Reporting periods differ, so you could have a finance calendar year that's different than what you have for tax. You certainly have different depreciation methods, particularly in the US and most likely in other countries too. So you have to be able to have specific depreciation keys for your tax requirements. Finance doesn't want anything to do with those. It's just a burden to them to even have to have them considered in part of the implementation. So tax folks, again, are having to make the argument as to why they should be included if they want to be part of the integrated system. Again, alternative depreciation methods, you may have differences in capitalization rules that need to be accounted for. One of the big obstacles I see is tax is always working a year behind. So they're doing the reporting to their authorities in the year following the business. Finance has closed the books. So if there's something that needs to be fixed in the prior year, finance doesn't want to open their books, but tax does this on a regular basis where something didn't get categorized correctly and they need to fix it to get the tax reporting correct. Expense, and one example of that is things that are expense for finance but might be capitalized for tax. Then there's just the general management of a budget, right? So tax department has their budget, finance has their budget. Who gets allocated? What's the basis for allocating the cost of an integrated ERP system? Is that fair to tax? Is that fair to finance? Discussions around what that cost actually is for your piece of the business. And the last item here is probably the most significant obstacle, both pros and cons, for being in an integrated system or being outside of an integrated system. The asset detail doesn't match, meaning you don't have the same starting basis between finance and tax. So an argument can be made that if you're integrated, when you post an acquisition value to an asset, it updates all of the depreciation areas with the same starting basis. So that sounds like a solution for not having the same starting basis. But then you roll in capitalization differences, and so it starts to get different. You roll in investment grants, that starts to look different in different depreciation areas. And another litany of items that could account for why there should be a difference. And tax says, hey, just give me the beginning basis, I'll create the record and then take care of all those tax unique items. So in a perfect world, you would have tax with the control that they need for the tax related things, finance would not be burdened with any unnecessary details, and they can manage their year-end closes. Tax can open up years, and they still reconcile, so that tax doesn't do anything unless they start with an asset acquisition, most cases. So you'd like to have the best of both worlds. So can you have it? That's the question. The short answer is yes, you can. So let's talk about what those scenarios look like for tax and finance. Left-hand side, I got two scenarios here. One I call the classic tight integration, which is what many of you probably are seeing today if you have tax in your SAP system. The other one, and the idea that I want to introduce, some of you may have something similar to this, I call relaxed integration, where there's not a hard tie for all aspects of the asset depreciation areas. But for example, let me just go back to the details. On the classic, you got the same asset number, same master data record, same asset class, but separate finance and tax depreciation areas. Yay, you get to have your depreciation keys that do different math, which is good. And you're posting the dollars simultaneously across all the areas. So from a classic design perspective, this all sounds good, i.e. all the control issues on where there are differences. Now, the relaxed design, moving to this bottom part, we have, the design says you have two assets, one for finance and one for tax. You have different number ranges. You have a tax number range separate from the finance number range. And you can have different tax asset classes. So typically tax has more detailed requirements. Finance will sometimes follow that, although they really don't need it. So in this design, finance could actually keep their higher roll-up asset classes while tax could have their details. So finance gets a benefit from this relaxed design. Same depreciation areas for both assets. That's an important part of this design. Same depreciation areas. If you got book 1, 10, 11, 12, 30, you're going to have those depreciation areas in both assets, finance and the tax. So what about the posting? You're going to post to the finance asset just like you do in the classic scenario. The dollars post to that asset number for finance with that asset class, and it updates all the acquisition value for all the depreciation areas. What's different here is you are now providing, in this relaxed design, you provide tax the ability to create their own assets with their own number range and own asset classes, and use transactions to post the money at that detailed level based on taxes analysis of the activity for the year. And I just gave away part of this design. It also means tax doesn't have to do this in the same month that finance is posting the dollars. They can do it in a following year, which is what most tax departments do. They're working a year behind, right? So they're analyzing last year's transactions and couldn't care less about the current year transactions, forecasting aside. So last bullet point, there are two ways that I'll show you in this scenario to post to the tax assets. The first one is you do a transfer, a 300 series. We'll make it a custom tax asset transfer, and you move it from the finance asset tax books only to the tax only asset tax books only. Okay, or you do a direct posting. Don't touch the finance asset. You simply post the dollars to the tax asset areas on the tax only asset. Okay, so what's the risk with this? We're going to talk about that. First, let me show you the classic scenario. So on the slide here, I call this the classic. You've got two assets. The first scenario is classic asset classes. I've got two standard finance asset classes, 1100 and 1110. One is for a building, one's for the escalator in the building. Two asset numbers, 599 and 600, two different account determinations because they're going to two different GL accounts, 1100 and 1110. And then the depreciation areas here, you see not only book 1, but also book 20 for state, book 90, 91, and 92 for the tax books. And I'm using US tax depreciation areas here. This could be another country with different names for their tax departments. So in the first case, the money, whether it's coming from a capital order, capital project, a purchase order, or just an invoice, the money is posted to the asset and it updates all areas, $900,000 in the case of the building, $100,000 in the case of the escalator. So the math works here because I've got a different depreciation key and I've got different useful lives by area. So I can get the correct tax depreciation, I can get the correct finance depreciation based on the differences that I can accommodate on this screen. This is the classic. This is what you'll typically see. The problem with this is, of course, is if tax really would like to have this broken down, this building broken down further, or take any of the asset categories where there's more granular opportunity for and requirements to report at a lower level of detail. So there's two options there. Within the classic design, you either create additional depreciation areas, you create additional asset classes, and you force the finance folks when they settle or post the purchase order to post to that lowest level of detail. That's where the finance guys start going, wait a minute, I don't really want to do this. This is no benefit for me, it's just for those tax guys. Tax guys say, fine, just hand us the acquisition values and we'll take care of it in our own tax system. So there you go. That's how we end up with the division of work to satisfy overcoming all the obstacles but with two different systems. And the minute you have those two different systems, then you start introducing variances that if not managed correctly, over the years, they get out of sync. Meaning you can't reconcile back, particularly if you talk about the follow-on activities such as transfers, retirements. Okay. So if you looked at this from a risk perspective in a finance integrated scenario, you would say, well, this is really low risk for me. This is what I do today. Maybe a little bit more risk if I have to give tax some additional detailed asset classes. But for tax, I got the same obstacles as to why I don't want to do this in an integrated system. I've got to work with those finance guys. I got to fight for some budget dollars if I need to add additional depreciation keys or areas or make changes. I got to fight to get the prior year open so I can post adjusting transactions and the like. All right. Okay, great, Kent. Now you've set us up. So show us how we can make this work inside of our ERP, inside of SAP, and get the benefits of both a separate system, i.e. a separate system and an integrated system. Okay, so I've outlined what that relaxed design looks like. Let's look at an actual example. Top example is where we're doing a transfer. I've highlighted in red the differences between the classic, which I show in the first column, and in the relaxed option, I have three assets. I have a building escalator as before. But then I took the main building, I split it into two. I have building improvements such as offices, lobbies, etc. And then I have the main structure. Now the bottom one is a direct acquisition. So let's look at this top one first. Okay, notice that I've got some unique asset classes. T1110 BLEQ, which is short for building escalator or building equipment. T2500 F-OL, that's short for improvements to the building, offices and lobbies. T1100 building main. Okay, so I got three tax assets, 101, 102, 103. Three different account determinations, which actually helps with reporting. And I've got this Y300. So I've transferred. So what does that mean? Okay, let's look at the depreciation areas between the classic asset where the $1 million starts and the three tax only assets. What I'm basically doing is from the depreciation areas only, which means the Y300 is limited to just the tax depreciation areas. I'm moving the money off of that finance asset down to my lower level. So finance says, yay, I'm out of this. I don't have to worry about it. I've got my $1 million depreciated over 40 years, straight line, and I'm good. Tax says, well, now I'm good because I've got 3 different assets. And the main variance between those is the escalator's 15 years. The building improvements is 15, except for my state, which is 20. And then on the building, I've got 3 different depreciation useful lives and methods. So now I'm happy because I've got it separated at the detail that I need. And just to expand a little bit on this, if a retirement or a transfer were to happen, that would be reflected on the finance asset. So in the following year, when tax is looking at the activity, not just new acquisitions, but also retirements and transfers related to the 4797, they pick that activity up and then make appropriate accommodations on their tax only. Is that double work? Well, yes, you've got finance work and you've got tax work, but that work happens anyway, whether you're using just classic assets or this scenario where you have 2 different assets, one for tax, one for finance. So that event occurs. It's just when does it get handled by the respective departments? The bottom transaction or option is direct acquisitions. And if you look straight down to the depreciation areas on the classic versus the tax, the main difference is we don't touch the finance classic asset. We leave those dollars there, call those reconciling totals. We simply move the appropriate, we'd simply post directly to those tax only assets. Since these don't have GL accounts, there's no required offsetting entry. We're just posting the money to these assets. In this case, 100, 300, and 600, and we get the same differentiation on our tax keys and useful lives that we need to properly do the math for tax depreciation. So what's the risk profile look like this? I would argue that similar to the finance, low risk for finance, but higher risk for tax on the classic, now I've got low risk both for tax and for finance. I've addressed this issue. I did leave the direct acquisition dollar approach with some moderate risk, and I did that just to highlight that if you don't do some reconciliation between the, let me back up, if you don't do some reconciliation between this $1 million on the classic asset versus your detail, you could run the risk of being out of sync, posting more money to your tax assets than what's really on that asset. With the transfer approach, once you get to 0, you're self-checking, right? There's no more money to move. You could move less, which would be okay if that's what you wanted to. But on the other one, the direct acquisition, potentially you have some higher risk associated with posting more money than what's really there. But I put that as a medium risk as opposed to a high. And you may have different thoughts about that. Okay. Here's a slide that'll put you to sleep if you're having trouble at night. What its purpose is in the white columns, I have the classic granularity associated with finance asset categories and asset classes. In the green, I have some tax detail that you typically see. If you look at that first column, I've put in bold. Theoretically, finance could have land improvements, building improvement, computer hardware, tooling, machinery equipment, office equipment, fixtures, vehicles, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 asset classes. That's all they need. Tax, on the other hand, needs roughly 20 or 30 to get to. Why? Because they have different useful lives and they have different depreciation methods that they want to use, which you could get in the classic, but they have different dollar amounts that they want to reflect for that granularity. And that's what's really driving this. And the granularity directly ties to the different useful lives. So with with one asset, you can't put multiple lines. With multiple tax-only assets, you can do that. Okay, so this is just a way to help you if you were thinking about this as to how your design might, at a high level, look. Fewer asset classes for finance, more asset classes for tax only. So there's something in it for finance there. They could get rolled up and not have to do as much detailed work as they do today. So how would this work for the tax side of it? And I've laid out a simple 4-step approach, keeping in mind that this is an activity that could happen at any time. It could happen second quarter for the first quarter of the current year, or it could happen in the second quarter of the following year for all of the prior years. So you have the advantage of deciding when do you want to start analyzing your finance transactions to get the granularity you need for tax. So what's the first step? First step is you extract that activity, whether it's annual or quarterly or the like, by transaction. So that then can be analyzed in step 2 by the tax accountants and see what they need to reclassify or change for tax purposes. Step 3, tax puts those into a SAP upload template that step 4 IT, or if tax is given the authority, actually uploads that detail into their tax-only assets. So this could also include creating the tax-only asset master data as well as posting the transactions to it. And here's some more detail around that in terms of some of the things to think about. Are you posting money to a new or existing, which can also be some of the issues that you run into when you have a single central classic asset, right? Typically, tax is wanting to separate their data into 2 groups. You've got sufficient detail, so you don't need to create a tax-only asset for every finance asset, right? Could be that you just leave it alone and you only add tax-only assets where you need that further detail. And then you go into your capital versus expense, or the adjustments, something you need to add money back or you need to take away in the case of retirements. And then is there some additional detail? We talked about these tax codes for properly reporting, whether it's a local or regional or country-based requirement. You now have the ability on this tax-only asset to use those evaluation groups to your advantage or other data fields. I think that the tax load, the template that's used could be, pick your favorite one, whether it's Windshuttle or SAP's RPA, or any of the 1,000 tools that are out there for posting transactions in SAP. The key is to get the template so that it fits with the way tax looks at the data, so that they can add the appropriate master data and get the beginning acquisition values as well as post the appropriate adjustments. Responsibility of putting it into SAP, I think, is a management discussion around separation of duties, authorization to make changes in SAP. As you know, with fixed asset module, you can restrict authorization to just certain depreciation areas. So that could be taken advantage of in that case. Okay, that's the essence of what I wanted to talk about when it comes to just tax departments and finance departments deciding whether they want to be collectively managed in the same system or whether they're going to manage their work separately. These references here talk about all the different obstacles, not just in SAP, but just ERP in general. So again, it's not unique to SAP. It's a common discussion, no matter the ERP system. All right, let's summarize and open it up for questions here in the last half hour. So I talked about the integration concerns between finances requirements and taxes requirements. And I've talked about a couple of designs, which I think have the opportunity to work for both departments, finance and tax, in mitigating, lowering the risk of concerns around data control, tax law changes, prior year changes versus current year changes, and the like. It is just a math problem, but we do have to make sure we have the accurate data so that we can apply the correct depreciation method to get, and the useful life to get the correct depreciation, and we can report it accurately with the right tags on it for local, regional, and country and global reporting requirements. So specifically, I've talked about those challenges. I've talked about a couple of designs, which I refer to as the classic or type integration, and then the relaxed, which has two options in it: transfers to tax only or direct postings. Then gave you a little idea of what that tax only asset process might look like. Okay, I'm going to turn it back over to Jessica, and we'll entertain questions.
Oops. All right. So the first question is, what is the #1 barrier to using SAP's depreciation system for calculating tax depreciation?
The #1 barrier that I've encountered is the reluctance to, quote, give up control. So the perception is that if you have your own system, if you have your own tax system, then you're in control of your destiny. And folks don't like to give up that, quote, control. I think the weak link in that is that you still have to get the acquisition data and the retirement data and the transfer data from the finance team. But that's typically the #1 barrier that I see. Oh, and one other. I have encountered some tax executives who said, I got burned by having my tax data in SAP, and never again will that happen to me. So to those folks, it's unfortunate that there's obviously a zillion different reasons, but I do encounter that from time to time. So there's this perception that it's not good.
Thank you for that answer. The second question is, I understand that SAP's depreciation calculation is often wrong and hard to understand. Is this correct?
All the SAP consultants out there are chuckling now. A common complaint, typically from finance or auditors, are saying, man, I'm doing this calculation on the spreadsheet here, and I'm not getting the same answer. And so first off, let me just say that is an incorrect perception. The math in SAP works. Folks often don't understand how it works, so you have to peel back that onion. It is a math problem, and you just have to understand what the math is. So useful life, the method, declining balance, 200%, 150% straight line. You have to understand that. You have to understand what's the acquisition value that you're starting with, and believe it or not, that can often be misunderstood. So it's really peeling back that depreciation calculation and understanding how it works. And the most common part of that that's misunderstood is in the first year of depreciation calculation, what is the starting date? You would think that would be simple, right? But it's not. Oh, I acquired it, posted the money in May. It's really, okay, what did the depreciation key say is the start date? So if it's tax, for example, doesn't matter when you acquired it in May, if it's acres makers, to use a US key, the start date's can always be the middle of the year. So you're only taking half of what a full year would be. Or if it's a building and it's a straight line, your finance team may say, well, we don't want to start till the first of the next month. So that period start date for depreciation is the often most misunderstood, which leads to the perception that it doesn't work.
The next question is, whose authorization is needed to allow tax department employees access to SAP fixed assets and tax depreciation?
So that's a great question. All right, let's take 3 scenarios. Tax accountants are included in the finance team, so the finance manager decides and works with IT. Second scenario, Finance accountants, asset accountants, work for the tax department manager. So the tax department manager has control. I've seen both of those scenarios. The third scenario is the finance manager and the tax manager both have control. So the tax guy says, hey, I've got my own system. I'm in charge of that one. Finance says, well, I'm working in SAP. So typically, if you have two department managers, tax and finance, that's a barrier to the having tax inside. So you have to get that resolved with IT and with your audit team in terms of responsibilities and SOX controls. It is okay to let tax make tax only adjustments. That's not well understood. There is functionality in the SAP fixed asset that allows that and allows you to meet the SOX requirements. So it really depends on which of those three scenarios exist in determining who has the authorization to work with IT to provide the access that's needed.
Okay. Next question is, does the configuration setup and process changes required for the relaxed tax integration solutions require major spend?
Okay, so right, so that's a great question. Hey, Kent, you laid out a great set of scenarios here that look positive. How much is it going to cost me? So there's two generic answers to that at a high level. One is, are you already in SAP in the classic design, but you want to implement the tax-only asset classes? So that scenario is most likely a less involved exercise. It would be a matter of setting up the basic config, tax-only transactions, tax-only assets and numbering ranges, and then doing a transfer. That could be a phased-in approach also, but less involved. Now, if you're in a separate tax system and you're going to bring all your tax data into SAP under this scenario, that's a little bit more involved, primarily because of the asset data mapping and the data migration exercise, not the actual setting it up. If anything, it might be from actually starting to work in SAP, it might be a little bit simpler in that you don't have a lot of historical data stored in your finance assets. So on a scale of 1 to 10, I don't know if this is fair to say, everybody's a little bit different. Going from a separate tax system to a relaxed approach in SAP is probably a 5 or 6. Taking an existing system and converting it to this relaxed approach is probably 3 or 4 on a scale of 10, whatever number of hours you want to put on that. Is it, I will talk about that. So is it a full year exercise? No. Is it 2 months? That's probably pushing it. Is it 3 or 4 months? Most likely. So if you wanted to use an average, I would say 4 months and then work inside out to see, is it less or more, depending on your scenario. And of course, you're only going to do this if you've also done your pros and cons and understood the value that you're getting, which should be tied back to all these obstacles that you have in reporting accurate tax depreciation, as well as some of the obstacles that you encounter on the finance side, because you have to have all this detail that you really don't need. It doesn't provide any value to finance. So I would argue that there's some benefit on the finance side as well as on the tax side that should be considered in any project.
Thank you, Ken.
Yep.
The next question, I'm going to let you decide. Somebody was asking if the slides will be distributed. That's your content. So
Yep, we'll do that.
Okay, so for the person who asked that, I'm going to go ahead and send you a separate message in the chat box with the ERPfixers email, and we'll have Kent go ahead and get those over to you. Okay. And then, let's see. Next question is, does SAP provide reports to enable tax depreciation reporting on the IRS 4562 asset depreciation and the IRS 4797 asset dispositions?
So the shorter answer is no. If you went looking for those two reports on the SAP report chain of reports, you would not find it. Is there a report that will get you close to that? Yes, the asset history sheet report can, with a little bit of manipulation, can help you extract that data. Then typically though, you have to download it into an Excel, manipulate the Excel to get it to line up with the worksheets of the two different reports. I'll put in a plug, of course. I actually have two reports that I have built in Excel workbooks that use queries to pull the data and show the results right alongside the IRS forms, the 4797, 4562. So there is a tool out there that I provide that helps tax departments report that information. I call it a faster time to analysis. So instead of wasting all this time getting the data, you spend your time analyzing the data.
Okay, we've got some extra time. That is all the questions that I received. If anybody has any last minute questions they would like to ask, please feel free to drop it in the chat box or the Q&A box while we've got Kent's time right now. Give you guys a couple minutes. If we don't get anything in the next minute or so, then we'll go ahead and wrap this up.
Thank you, Jessica. You're an awesome host.
You're a great presenter, Kent. We're so happy to have you again, and we look forward to another presentation sometime next year.
Absolutely.
So it doesn't look like, just let me double check to make sure I don't want anybody's questions missed. And it looks like we're all good. And to the attendee, if you could check your chat, I went ahead and sent the email over for you to grab those slides from Kent and I. And thank you so much, everybody who took the time out of their day today. And thanks again, Kent, for presenting with us. And we look forward to the next webcast.
You bet. Thank you very much. Everybody have a great day.